Close your eyes and imagine the largest market on Earth. Not stocks, not real estate, not crypto. A market so big, it doesn't even fit on a map. A market worth over $1 quadrillion. And most people have never heard of it. This is the shadow market, and it's bigger than everything you know combined. Here's the uncomfortable truth. The global economy, you see, is not the one that actually decides what happens. Right now, governments argue over billion-dollar budgets. News channels panic over trillion-dollar debts. Meanwhile, behind the curtain, a system quietly moves, some so large, they make those numbers look cute. And it matters more today than ever. Because when things break, this is where they break first. Let's rewind. In the real world, money moves slowly. You earn it. You spend it. A bank sits in the middle. But in the financial world, money learned a trick. It learned how to exist without existing. Enter derivatives. A derivative is not money. It's a contract about money. A promise about a price. A bet on what something will be worth later. Oil, gold, interest rates, stock indexes, even other derivatives. Now here's the key detail most explanations skip. These contracts don't need the real thing underneath. You don't need oil to trade oil futures. You don't need bonds to trade interest rate swaps. You just need two parties agreeing on a number. So the same underlying asset gets referenced again and again and again. Like photocopying a house deed 1,000 times and trading the copies as if they're houses. That's how the shadow market grows. By the early 2000s, banks realized something. If you trade these contracts privately, not on public exchanges, you can scale infinitely. No price transparency, no public order book, no real oversight. This is called the OTC market. Over the counter. Sounds harmless. It's not. By 2008, this hidden web had grown massive. Credit default swaps, basically insurance on debt, exploded. Banks insured banks. Who insured other banks? Who insured the insurers? Everyone felt safe. Until one firm failed. AIG. When AIG collapsed, governments didn't bail out a company. They bailed out the contracts connected to it. Because if those contracts failed, the entire shadow system would unwind at once. That's the irony. The free market survived only because taxpayers quietly backstopped a private casino they never knew existed. Fast forward to today. After reforms, the system didn't shrink, it reorganized. Interest rate derivatives now dominate. Why? Because when rates move, everything moves. Mortgages, governments, corporations, pensions. A 1% shift can trigger trillions in contract revaluations. And here's the uncomfortable math. The quadrillion-dollar number isn't money at risk. It's notional value, which sounds reassuring. Until you realize even a small mismatch can collapse liquidity. It's like saying a nuclear reactor is safe because only a tiny part actually explodes. The hype says this market spreads risk. The reality is, it concentrates it invisibly. No one sees the full picture. Not banks, not regulators, not central banks. Each institution sees its own slice and assumes the system will hold. History suggests otherwise. When panic hits, these contracts demand collateral immediately, cash, right now. And when everyone asks for cash at the same time, there isn't enough. So here's the bigger question. If the largest market on Earth exists mostly off-screen, if its failure requires public rescue, and if its size keeps growing faster than the real economy, is this system stabilizing capitalism or quietly replacing it with something far more fragile? Because the shadow market doesn't need to collapse completely. It only needs to blink.